If you have been having a losing streak, trading smart money concept, blowing accounts upon accounts of your trading capital, and really struggling to understand what this smart money is really all about, this video is for you. And in today's video, I'll be looking at the ultimate guide to smart money concept and the 3 stages or steps you will have to checkmate before you click the buy or sell button. So now, what is smart money concept? Smart money concept is simply a trading methodology that tends to follow the footprint of big banks. Okay, we understand that 95% of retail traders loses money, and that is because we are trading against the big banks. So what do we have to do in order to be among the 5%? We have to follow the banks, and that is where the smart money concept originated. Okay, we are trying to follow the bank's footprint because they leave footprint in the chart, and I'm going to show you in today's video how to discover that footprint and what you should be doing instead. First thing first, in smart money concept, you need to understand your directional bias. Okay, our first stage is the stage I call the setup stage, because as a trader you need to have a setup. You want to see something play out before you can start engaging the market. And what are you looking for in this setup stage? The first thing you are looking for is 1, you're looking for liquidity. 2, you're looking for change of order flow. And 3, you're looking for point of interest. Let me explain further. You see, the key to succeeding in smart money is understanding liquidity concept. Now, let's assume that we have an external point of interest. Okay, this is part of your setup. Okay, your stage 1. You want to be seeing setups that will tell you, okay, I'm about to sell this particular financial asset, be it crypto, forex, stocks, indices, and so on. Now, when price approaches this point of interest, you want to see liquidity being taken first. So you want a situation whereby liquidity will be taken either close by, or we have some previously left equal eyes up here that needs to be run first. Okay, so what your eyes need to be doing is to train your eyes to see those liquidity, because the market do not move if it does not take liquidity. Write it down. The market will not move in that direction if it doesn't take liquidity. Why? Because liquidity is simply the fuel that the market needs to operate. Okay, so liquidity is simply the fuel the market needs to move, because if the market wants to have a prolonged bearish move, it has to take liquidity. So your first thing that you need to look for your setup is if liquidity has been taken. Now, once you identify that liquidity is taken, you go to the next point, which is under the setup stage, because all of these, you are not taking a trade. Even because liquidity has been taken doesn't mean you should click the sell button. No, you have to also be patient. Wait for a change of order flow. Now, what do I mean by order flow? Order flow is a situation whereby price keep moving in one direction. Okay, let's assume the order flow in this case is bullish, meaning the lows are protected. Market did not take the lows. Everywhere on the chart is bullish. Now, the moment price takes out the low, okay, the recent lows, I like taking the recent lows here. In this case, I will consider that there's a change in what? Order flow. Now, do not be confused with my terminologies. In this case, the order flow is your chalk, is your shift in market structure, whatever name has been given to it, or especially when you see a quasi-model play out, a QM pattern. A QM pattern is simply this move here. If you don't understand what a QM pattern is, I did a video. I'll put it in the card up here for you to watch after this video. Okay, so what you want to see is a change in order flow, because the order flow here now switch from what? Bullish to bearish. Okay, so we want to see that market changing from bullish to bearish. So this is part of a setup. Now, because market has changed, doesn't mean you should take the trade outrightly. Okay, there are other things you need to consider when trading smart money. So now that takes us to the third point here, your point of interest. Now listen, whenever there is a change in order flow, or there's a shock, or there's a shift in market structure, or you have a quasi-model pattern, the market will always leave behind point of interest for you to trade. Okay, we are going to have series of point of interest. It could be 1, it could be 2, it could be 3. It all depends on what the market gives to you. So in this case, you might have series of what? Point of interest. Alright? Now, once you complete this first 3, this is stage 1. Once you complete this first 3 points, this is stage 1, you then move to stage 2. Okay? Your stage 2, I call it the cleanup stage. Meaning, you are trying to clean up some things that are not appropriate for you to take the trade. So, in the cleanup stage, what are you looking for? Number 1 is to refine your point of interest. Okay? Using what I call discount and premium. Okay? You refine your point of interest using premium and discount levels. Number 2, what are you looking for? You then choose point of interest in trading zone. Okay. Now, in the cleanup stage, which is stage 2, the first stage is setup stage, the next stage is cleanup stage. In the cleanup stage, all you need to do is to simply clean up this point of interest, because you are not going to be trading all this point of interest. Okay, what you need to do is to clean them up, divide them into trading zone and non-trading zone. Now, the way to do that is to use the concept of what? Premium and discount. Okay, you are going to calculate or compute on the chart here your areas of premium and discount. For example, you take your Fibonacci from top to down, and then you measure. The 50% level is equilibrium. Anything below equilibrium is discount, meaning price is cheap. And anything above is premium, meaning price is expensive. So because you want to sell, you have to be selling in premium, and if you want to buy, you have to buy. So this should be at the back of your mind. You sell in premium and then buy in discount. So what it means is that you will eliminate these points of interest. Okay, this point of interest should go because it's not in your premium zone. You want to be trading point of interest that is in premium zone, not in discount, because you are looking for what? To sell. So this will go. This also, it all depends if you are going to use confirmation in here in the lower time frame. Okay, but the best point of interest mostly are those at the extreme, and not only that, the point of interest must have some form of imbalance in terms of what fair value gaps, strong momentum, and the rest. If you don't understand that, I will link in the card up here a video for you to go and have a better understanding of what price imbalance is all about. Okay, so what are these points of interest? Your point of interest in this case are your supply and demand zones. We have your order blocks. I like looking at the IPA candle. Okay, these are the few things, and there are other things that some people look at: breaker block and the rest. They look at fair value gap, okay, FEG, and so on. I personally, I look at just supply and demand, and then the IPA candles. Now, what is the difference between other blocks and supply and demand? To me, they're the same. Just that different people comes up with different name for their trading strategy, but they are all supply and demand zones. Okay, so in that case, you are going to use that as your point of interest. So identify a supply zone up here. Since you are looking for a sell, identify a supply zone up here where price will get in, and then you start to trade. So by so doing, you eliminate 2 points of interest here now. Okay, because most people will start looking for trading here, and they end up having what stop out because they do not understand the concept of premium and discount. So you have to wait for price to come in discount zone. Okay, when it comes in premium zone rather, you can then look for the trade, which will take us to the last, the number 3 stage that you need before you can start to press the buy or sell button, and I call it execution. Execution what stage? At this stage here, this is where you decide to buy or sell. Okay, and what are you looking for in this stage? What you are looking for is number 1, your entry. Now, this your entry could be risky entry or confirmation. Okay, it could be risky entry. It could be based on what? Confirmation. I will touch on that soon. Then the last one is you are looking for liquidity. Liquidity. Now, why do you look for liquidity? For take what? Profit. That's all. For take profit, where you expect price to move to. So the execution stage here simply means you taking the risk, the trade. In this case, when price gets there now, by risky entry, this is what you do. You simply take your short tool, use the limit order, and then enter that trade with stop loss above. Okay, above, and then you target the next liquidity point. For example, let's say this is the liquidity you are looking at. So in that case, you have a 3 to 3.9 out. So this is a risky what? Entry. Why is it risky? Because you are not waiting for confirmation. You are only satisfied with what you see here, and you take the trade and price move. But if you are you don't really appreciate risk that much, you can wait for confirmation. Okay, waiting for confirmation. I did a video. You can go up here to look at that. So now let's look at the chart and explain all of this. I'm going to use the gold market. Okay, because these are trades we took in the VIP group. So we are looking at gold. Now, in gold, price came up to this external weekly zone. Okay, this zone, we analyzed this in our member area. Okay, price came in here, and because price was in here, we were now, our buyers shifted from bearish, okay, bearish buyers to bullish buyers. We wanted to go long. Okay, but having in mind that price may continue going lower. Okay, because this is an anside already, but what we were considering when price was here was that we expect a push up, and then probably price may respect some of this weekly supply zone. Okay, and that's what we're looking for in gold. So when price was here, this is the external point of interest. Okay, so now when we went to the daily, we wanted to see a change of what? Order flow here. We wanted to see a change of what? Order flow. And what happened on the daily, we had that change of what? Order flow. Price created the change of order flow here. Why is it a change of order flow? Because as you can see, prior to that time, price has been bearish. Okay, in gold, we have been bearish. Prior to that time, price came down and tapped into this external weekly demand zone. So price moved from there and created what? A break of structure, a shift in order flow rather, because there's difference between a break of structure and a shift in market structure or chop. So now, when price creates a quasi model, as I said earlier, price will create multiple points of interest. Okay, like here we have one point of interest here, and we have the other one here. Okay, for this trade, we have first point of interest, second point of interest, and if you go to the 4 hour, you're going to see more point of interest. Okay, but I won't go there so that this video will be precise. So now, as a trader now, you have to now checkmate or highlight those points of interest so that you can take your trade off it. So we have this point of interest here. So I'm going to delete this. Now, because price has created what a chop, doesn't mean we start buying. Maybe from here we start buying. This is the advantage of being a smart money trader. There's nothing wrong actually you placing your buy here. Okay, if this suits you, the stop loss below, as long as you know your point of invalidation, there's nothing wrong. It's just that it takes time for you to be in profit, and secondly, your risk to reward will be very small. You're going to have a small risk to reward. So because of that, as smart money traders, we wait for price to do the pullback. Okay, as I said, nothing wrong for you to enter here. Okay, there's nothing wrong as long as you know your point of invalidation. But instead, we want price to pull back to our point of interest. Now, if you take your Fibonacci now and then measure from here to there, you can see that we have 2 points of interest. One just sitting at the equilibrium level, and this sitting at what? Discount. The further away a point of interest is to a discount zone, let's say you want to buy, the more the distance, the better the trade. Okay. Now the downside is price may just tap in here and then move to the upside without getting here. Okay. So that is why this area is also considered good, because that equilibrium level, you can look for confirmations before taking this trade to the upside. But as in this example, price didn't move from here. Instead, price came down to this level before moving. Now, in this case, you move to a lower time frame, okay, like in the 1 hour, for you to be sure that price will continue moving to the upside. Okay, so when price came in, this is 1 hour here. When price came in here, price created what? A chop. Now, in your confirmation, all you are looking for is what? A chop, a shift in order flow. Okay, in this case, we have a shift in order flow right here. Okay, and then you repeat the same process, meaning you wait for price to come down to this level. We have 2 points of interest here to trade off from. Okay, so let's see, we extend this. By the way, this point of interest is great because we have inducement already, and you have to make sure you see inducement before you take the trade. So you can see price came into this point of interest. The first one, if you took this trade, probably price, depending on how you manage the trade or where you place your stop loss. If you are taking this place and your stop loss is at the point of invalidation, then you are good. But in this case, you can see the extreme is better. In this case, you can take this trade and then aim at liquidity point up here. Probably you exit your trade right here. Exit your trade right here. Okay, this zone here. What's happening? I can't pick mine right here. So this is where I will be exiting, because all of these are hindsight. Okay, but if I'm to, when we took this trade, I was targeting here, clearing this liquidity. So that gave us a risk to reward of. So the thing is, you don't have to go to the 1 minute, 5 minutes to take your trade. This is a 7-hour trade. Okay, you can easily bank this 7-hour trade easily just by following these simple steps. Okay, so these are what you should be doing week in, week out, trading a smart money concept. Identify your 3 stages: the setup stage, the cleanup stage, and the execute stage. Once you master this and understand what are the other elements within these stages, you will have a smoother experience as a trader. If you have any comment, make sure you put in the description. Like this video, subscribe if you haven't. Subscribe. If you haven't subscribed, and I will see you in this video.